Okay, let's talk briefly about capital structure. It's a pretty wide topic in corporate finance, but we can simplify it into sort of an intro course and what they usually cover. So capital structure, what does that mean? That means how are you financing your business? So a business can't run without money. Where are you going to get this money before you start actually completing business transactions and earning your own money? Well, we basically look at two different ways of raising money. There is debt. So that's things like issuing bonds to investors. You give them a piece of paper, they'll earn some interest, and you can take that money today from them and actually invest it in your business. Bonds or other long-term issues that work similar to bonds are basically how we're going to deal with debt in this course. And the second is equity. And again, equity can come from individual investors who actually buy a share of your company. So that can usually come in two forms that we're going to talk about, are common stock, or common shares, and preferred stock. So they're just different classes. Basically, it depends on how dividends get paid out when there's extra earnings lying around and things like that. So we're going to look at this whole M&M world here that we've listed. Modigliani and Miller, it's a really important topic, and they have a couple propositions. Let's look at the world without taxes for now. And there's two important concepts for M&M. They call them propositions. So the whole idea with M&M is that obviously when we can finance through debt or through equity, we like to think that there's probably one better way of doing it. But in the M&M world, they say there is no difference in creating value for the firm. So that's what M&M is all about, is creating value for the firm. We obviously want to increase that value so that we have more for shareholders. So in a world without taxes, Modigliani and Miller say that the value of the unlevered firm is exactly equal to the value of the levered firm. So and levered just means that you're levered by debt. So levered or leverage means that there's some debt in the firm. Unlevered is completely financed by equity. So they argue that it doesn't matter whether you're financed through completely debt, completely equity, or some combination of the both. If you're levered at all, the value of the firm has got to be the same as if you were not levered. That's kind of the first proposition, they call it. And then the second one is actually calculating the rate of return. So the rate of return on your equity has got to equal, this is for a levered firm, so they're saying assuming you do have debt, I'll just write levered, it will start with the rate of return on your unlevered debt, on your unlevered company, I'm sorry. So again, this RE here is if you have no debt at all. This is just if you're completely financed through equity. But then we're going to, on top of that return, because we should have a different return based on the debt piece, we're going to take our debt to equity ratio, so the amount of debt you have compared to the amount of equity you have, times the difference between that unlevered rate that you're getting from equity and the rate that you're paying on debt, or the cost of debt, the rate of return on debt. So these are the two key pieces for Modigliani and Miller, and again, this is in a world without taxes. They're both centered around creating value, and we're going to look at the return for a levered firm in a slightly different way when we talk about the WACC. So let's look at that now. Okay, WACC is simply the weighted average cost of capital. So we've already looked at doing NPVs and discounting all of our cash flows back with a certain cost of capital. Well, now we're going to say, okay, this cost of capital is actually going to be developed when we have a firm that's partially financed by equity and partially financed by debt. So the return, or the weighted average cost of capital, so we'll call that the return for the WACC, is simply going to be the return on your equity, so basically what investors demand, times the percentage of the value of the firm that's based on equity. So we can think of that as equity out of the total value of the firm, and that value is usually, again, made up of debt plus equity. So you can think of this, and this is where it gets its name, weighted average, This is sort of the weight of equity in the firm, and this is the cost of equity, or the return on equity, plus the debt piece. So the return that you're getting on debt, or the cost of debt, times the percentage of debt in the firm. So that's what this bracket is. That's the percentage or proportion of debt out of the total value. Now the only difference is with this debt piece is that on debt, it's basically a tax benefit. We don't get that on the equity side, so we have to multiply this by 1 minus the corporate tax rate. So debt has a tax implication, equity does not, and this is the weighted average cost of capital. So often they'll have sort of a two-part question where they'll, remember in M&M we developed a formula for RE, or the return on equity in a firm that's levered or not. They'll ask you a two-part question where we have to solve this in order to put it in here, and then solve the ultimate weighted average cost of capital. The key part about weighted average cost of capital is that we want to keep that as low as possible. We know this from our MPV stuff. As the WACC goes down, the value of the firm goes up. And since we're always trying to increase the value of the firm, we want to minimize the weighted average cost of capital, because that's going to have a lower discount rate, so future cash flows will discount back to a higher value. Okay, we'll look at some examples to calculate the WACC and some M&M properties as well in the next video. Thanks.